Hello and welcome to PPC Money Matters, a channel that covers everything regarding stocks and investing, personal finance, and opportunities as a self-employed in the finance industry. I'm your host, Finn. In today's video, I'm going to tell you the story of GameStop, the video game retailer that went from being on the brink of bankruptcy to becoming a meme stock that shook Wall Street. And then, how it managed to survive and thrive after the hype died down. This is the rise and fall, and rise, of GameStop. GameStop is a company that sells new and used video games, consoles, accessories, and collectibles. It was founded in 1984 as Babbage's, a small software retailer in Texas. It grew rapidly through acquisitions and mergers with other video game chains, such as Funkoland, Software Etc., and EB Games. By 2004, it had over 5,000 stores worldwide and was the largest video game retailer in the US. But then, things started to go downhill for GameStop. The rise of digital distribution platforms like Steam, Xbox Live, and PlayStation Network meant that fewer people were buying physical games and discs. The emergence of online retailers like Amazon and Walmart also posed a threat to GameStop's brick-and-mortar business model. GameStop's revenue and profits began to decline year after year, and its stock price plummeted from over $60 in 2007 to under $3 in 2019. Many analysts predicted that GameStop would go the way of Blockbuster and Toys R Us and file for bankruptcy. But then, something unexpected happened. In late 2019, a group of investors on Reddit's WallStreetBets forum noticed that GameStop was one of the most shorted stocks in the market. Short selling is a strategy where you borrow a stock from someone else and sell it at a high price, hoping to buy it back later at a lower price and pocket the difference. But if the stock price goes up instead of down, you have to buy it back at a higher price and lose money. This is called a short squeeze. The Reddit investors decided to band together and buy as many shares of GameStop as they could, driving up the price and forcing the short sellers to cover their losses. They also used social media platforms like Twitter and YouTube to spread the word and encourage more people to join the movement. They saw this as a way of sticking it to the Wall Street elites who had been betting against GameStop and other struggling companies. The result was a historic rally that set GameStop's stock soaring from around $4 in December 2019 to over $480 in January 2021. That's an increase of over 11,000%. The Reddit investors made millions of dollars in profits, while some of the hedge funds that were shorting GameStop lost billions. The media dubbed this phenomenon as the GameStop saga or the Reddit rebellion. But the frenzy didn't last long. The stock price soon crashed back down to around $40 in February 2021, as many investors cashed out their gains or got scared by the volatility. Some of the Reddit investors also faced legal troubles or backlash from their families for gambling with their life savings. The regulators and lawmakers also stepped in to investigate the situation and prevent market manipulation. So what happened to GameStop after the dust settled? Did it go back to being a dying company? Well, not exactly. GameStop actually used the opportunity to raise over $1 billion by selling some of its shares at inflated prices. It also hired a new CEO and board members who had experience in e-commerce and digital transformation. It announced plans to expand its online presence, diversify its product offerings, and partner with other gaming companies. GameStop also benefited from the launch of new gaming consoles like the PlayStation 5 and Xbox Series X, which boosted its sales and customer loyalty. It also received support from some prominent investors like Ryan Cohen, the co-founder of Chewy.com, who became its chairman and largest shareholder. Cohen believed that GameStop had a lot of potential to become a leader in the gaming industry. As a result of these changes, GameStop's stock price rebounded from its lows and stabilized around $200 in late 2021. It also reported positive earnings for the first time in years and beat analysts' expectations. GameStop proved that it was not just a meme stock, but a company that could adapt and innovate. The story of GameStop teaches us several lessons about investing. Firstly, it highlights the importance of being aware of the changing market trends and evolving business models. Companies that fail to adapt to the digital age and online competition may struggle to survive in the long run. Secondly, it shows the risks and rewards of short selling and market speculation. While some investors may make huge profits from betting against a stock, others may suffer significant losses. It's important to understand the risks involved and not invest more than you can afford to lose. Thirdly, it demonstrates the power of social media and online communities in shaping market sentiment and influencing stock prices. The GameStop saga was a prime example of how a group of individuals with a common goal can create a movement and disrupt the status quo. Finally, it emphasizes the importance of doing thorough research and analysis before making investment decisions. While the GameStop frenzy may have been tempting for some, it's crucial to consider the fundamentals of a company and its long-term prospects. In conclusion, the GameStop story serves as a cautionary tale for investors to be careful and informed when making investment decisions. It's crucial to be aware of the risks and opportunities in the market and to invest wisely with a long-term view. Thank you for tuning in to Money Matters, a channel brought to you by Pinnacle Personnel Consultancy. PPC is a dynamic and innovative company. We're committed to providing exceptional networking events and fostering connections within the finance industry.